Hello everyone, I'm Amita Sharma. My today's video is on the topic of cost concept, which is said to be a very important part of managerial economics or any other businesses. In this topic, we will be covering what exactly the cost is. We can call it as cost of production. Along with this, what all are the various types of cost that are associated with the business that we'll be studying under the various cost concepts. Then we'll be talking about what is the theory of cost, in which we will be covering the relationship of total cost, fixed cost, and variable cost, and how to calculate them, and the relationship of marginal and average cost. Now, what is the cost? Cost simply talks about the amount of expenditure incurred in acquiring something. In business form, it simply refers to the expenditure that is incurred to produce an output or any kind of services that we had already studied in the last video on production. This cost incurred in connection with raw material, labor, other items constitute the overall cost of production. It simply says that what is a cost? The cost is basically the expenditure that is incurred by the company or a business firm in order to produce any kind of output. Either a company, they are dealing in laptops, producing laptops, certain handsets, certain kinds of clothing, certain kinds of FMCG products. So any kind of good or any kind of service the company they are dealing with, its cost is simply in order to produce any kind of output, in order to make a kind of finished laptop or a handset. What all are the cost which is being incurred by the company, that is considered as the cost. So what are the various types of cost are there, in what areas the cost has been incurred? It's like, say for example, you are paying a certain amount of money in terms of acquiring some raw material, right? If you are a manufacturer of clothes, then in that case you need to pay certain amount of money in order to acquire some raw material, right? So you'll be acquiring some kinds of raw material for this. Along with that, you are going to pay certain kinds of wages to the laborer also, workers also, who is going to make those particular cloths of different colors and shapes and designs, right? Who is going to operate in those machines? Who are actually going to operate the machineries, right? Machineries are there, some are handmade, some are machinery based, but someone is there who is going to work or giving a command or for the machinery, so you need the laborer also. So you will be paying certain amount of money to the workers as well. Along with that, you are also going to pay certain amount of money in terms of rent of the building in which the production is taking place, the lightings, right, of fan, tube lights, like that. Along with that, you also need to pay certain amount of money in terms of maintenance of the machineries as well, right? So these are the various types of general costs that has been associated with the production. So it is very important, either if it is a production concept or a cost concept, both are equally important because both are somewhere or the other related with one another. Now, a managerial economist, the economist who is taking the managerial or business decisions, they should have a clear understanding about that what all are the various costs which are being associated with the business. These are the different costs, but along with that, there is a separate cost concept is there that is very important for the economists to understand, business managers to understand. What are the costs? Which cost is associated with which area? So they should have a clear understanding with that cost, right? So that we'll be understanding in the next slide, the what are the entire different cost concepts. So it is very important for the business managers to understand this. Along with that, because it will be very much helpful for them to analyze the things, to visualize the things, and take better decisions. And one more important thing is that whenever any kind of production output, means any kind of output or the result, which take place after doing the entire production of a particular good, then its output relationship is always being checked with its input or the input cost. Reason being, because that particular cost output relationship is very important level to determine what is the level of production you have done, right? Say for example, you have produced something with maximum possible cost, again it is going to show your level of production. If you have produced something with minimum possible cost, then it is showing a certain time period, that is an example of your efficiency and the effectiveness. Cost concepts. There are various types of cost which are being used in business decisions. And it is very important for the managerial economist to understand the various types of cost and its usage in order to understand the business situations in a better manner. Now we'll be studying each cost one by one. These are the various types of cost like actual cost, opportunity cost, short run, long run cost, fixed cost, variable cost and total cost, incremental and sunk cost and average and marginal cost. So these are the various types of cost which are being associated to the business. So start with the very first one, that is the actual cost. Actual costs are those costs that involves the financial expenditure and it has been incurred for acquiring any kind of product. These expenditures, all those expenditures which are recorded in the books of account, they all are said to be the actual cost. Right? So for example, when the company they are making some kind of expenditure in terms of paying the wages to the workers, paying the salaries to the employees, purchase of machinery, purchase of raw material, these all are the expenditures in which we will be counting them in the books of accounts. They all are actual cost, right? Although we know that we have an income and expenditure statement, right? We have the entire profit and loss statement. So all those transactions which are recorded in those particular books, they all will be counted as actual cost. Another is the opportunity cost. Opportunity cost is refers to the loss of earning due to opportunities foregone. It may be due to some scarcity of resources or any other reason. Opportunity cost simply means the next best alternative foregone. Say, for example, in a general business decision making, um, a manager has two options to choose. He has got a project A and project B, and at this time, he can only choose one project. So, he has seen the pros and cons and the challenges both on the both the projects A and B, and while looking after both the projects, he has opted for project A and left out project B. So, what is the opportunity cost? It simply says that the next best alternative that you have foregone, right? So, the B is the opportunity cost, right? So, B is basically the opportunity cost. Now the next is the short run and the long run cost. Short run and long run cost simply talks about the time period within which certain kinds of costs are being incurred. Short run refers to the time period within which a firm may make some kind of changes in the output, right? So say for example, in a short run time period, if the company they want to increase or decrease down the production, right? So any type of cost which is being associated during this particular period of time may be considered as short run cost, right? In the short run, the company they can make certain kinds of changes in their output in terms of production, in terms of increasing their number of workers, increasing their wages. So these are the kind of costs that they can incur in the short run, right? When we talk about long run cost is simply talks about the cost which are incurred on some kind of fixed assets like plant, building, machineries, In the long run, even the fixed cost is said to be variable. It simply says that long run is said to be a time period of 5 years, 10 years and more. This is a time period within which the company they can make some kind of expenditures which the company they do not do it on a regular basis. Like the company they can buy their own plants, the company they can buy can construct a new building or purchase a new building, and the company they can also spend certain amount of money in terms of building or buying a new technology, advancing its new technologies, purchasing a new machinery and etc. So these all the expenditures are fixed, and costs are again being variable in the long run. Right. So this is the short run and long run cost. Then the next is fixed cost, variable cost, and total cost. Fixed cost, what is a fixed cost? Fixed cost, this is a cost which do not vary with the changes in the output. This is a cost which remains same, right? Which do not change with the changes in the output. Say for example, if the company they want to increase the production by from 20 units to 25 units or from 25 to 30 units. So there is a certain amount of cost for certain items which do not changes with the changes in the output. Say for example, taxes. The company they need to pay the yearly tax, either you produce 20 or either you produce 25 or 30. The tax remains the you need to pay the tax. Now the next is the rent also. Now either you are producing a single unit or you are producing a 20 unit. You need to pay the rent, right, for that particular space. So these are said to be the fixed cost of the business. What is a variable cost? Variable cost is the cost which changes with the changes in the output. Like variable cost basically covers those items which are being used for the production of certain kinds of outputs. Like say for example, if I am producing 10 cars in a month and I want to increase that particular production of cars from 10 to 15, then in that case what items I should require? What are the things which I require? I require labor, right? I require extra raw material also, steel, metal, glasses, various equipments, tubes. So these things I require, so I need extra raw material, right? So I need to purchase the raw material, again it is a cost. I'll be paying extra wages if I'm putting some more number of workers, then I'll be paying them extra wages. Wages will be there, right? So these all are the cost which is being associated with the output are said to be variable cost. Because as you increase or decrease the level of production, the cost also changes. If you increase the production, the cost increases. If you decrease the production, the cost decreases. What is the total cost? Total cost is basically a combination of fixed and variable cost. Total cost, how we calculate the total cost? Total cost is equals to fixed cost plus variable cost. Now the another concept is incremental and sunk cost. What is an incremental cost? Incremental costs are the added cost of change in the level of production. Incremental cost simply talks about any kind of cost that is being incurred by the company in terms of adding anything in the production. Say for example, if we are adding any kind of new product, right? New product we are launching, right? In terms of adding any new thing into the business, whatever the cost which has been associated with it will be considered as the incremental cost. Like you are buying, you are coming up with new technology, right? So with the new things that is you are giving it to the business, new machinery you are giving it to the business, right? You are making some kind of, you are making some changes in the production process, right? The sequence you have changed, the cost that has been associated with in adding any new thing to the business, with adding anything into the business will be considered as incremental cost. Now the next is the sunk cost. What is a sunk cost? Sunk costs are the costs which cannot be altered in any way. Means this is a cost that is being incurred on constructing a factory or a building, right? This is a cost which is being incurred for a particular purpose, right? Like this is a cost which has already been incurred and we cannot alter that particular cost. That cost is said to be sunk cost. Like say for example, when you have planned to start up your own business, now you thought that you need a particular building in which you will be working. Now the you had made that particular thought that I'm going to construct this building. So when you have made a particular building or constructed the complete building, so whatever the cost that you have incurred, right, you cannot make some changes in that particular cost. Such cost is said to be sunk cost. Means sunk cost basic meaning is it cannot be altered when the operations are increased or decreased, right? So it is once incurred, you cannot make any kind of changes into it. Then the another kind of cost are average and marginal cost. By the word itself, average and marginal cost, what is our understanding? Average cost or unit cost is equals to total cost divided by number of goods produced, right? So we can calculate it as total cost divided by number of units or the goods produced. Right? So through this we can calculate average. Now what is a marginal cost? Marginal cost is the cost of producing an additional unit of output. Right? What is the cost of producing any single additional unit of output? Right? Marginal cost is the addition made to the total cost by producing one more unit of output. Say for example, if a total cost of producing 3 units, we have 3 units we are producing. Now, in order to produce these 3 units, the total cost which has been incurred is 1550, right? We are producing 3 units, but 1550 is the expenditure. Now, and the total cost of producing four, if you are increasing one more additional unit, and the total cost which has been incurred is 1900. So how we will calculate the marginal cost? By increasing any single unit. What is the additional cost that is incurred? That is 350. It is 1550, 1900 minus 1550. Means when you are increasing the production with every single units of input, what is the change or the change in terms of cost which is being incurring? It is said to be the marginal cost. Now the short run cost function. This is a time period within which a firm can vary its output by varying only the amount of variable factors. These factors are raw material, labor, etc. Short run is basically a time period within which the firm cannot alter their fixed factors like building, machinery, technologies. It can be changed in the long run but not in the short run. Say for example, a firm wants to increase the production in the short run. It can do so only by hiring new people, by buying some more raw materials. They can do it, but they cannot change the size of their business. They cannot change any kind of technology. They cannot change any kind of change in terms of plants and building. So in the short run only variable factors can be varied and fixed factors will remain constant, right? So first of all, just have a look on the various formulas through which we will be calculating the various costs. Right, so very first is the total cost. Total cost, how we calculate the total cost? It is a combination of total fixed cost and total variable cost. Right. Another is, we know what is a variable cost and what is a fixed cost. Now another is average fixed cost. How the average fixed cost is calculated? It can be calculated by average fixed cost is equals to average total fixed cost divided by output. Q is the output, right? Then average variable cost can be calculated as total variable cost divided by output. It is simply an average. Then average total cost is a combination of total cost divided by output. And the marginal cost can be calculated by change in total cost divided by change in output. So this is the way we will be calculating the complete cost. So this is the entire schedule within which the entire cost will be calculated. Now we had understood the entire formulas of how we will be calculating the various types of cost. Now we'll go through one by one. Start with the very first one. The Q stands for the output. Now we have output 0 to 10. We had increased the output, as it has been already been said that in the short run the fixed input or the fixed cost will remains the same, only the variable cost will change, right? So with this the output is changing, right? What is the total fixed cost? Total fixed cost will remains the same, 100. It do not change with the changes in the input. Here the different levels of output are mentioned, with total fixed cost, total variable cost, total cost, marginal cost, average fixed cost, average variable cost, and average total cost. Now how we are being calculating all the costs? Start with the total fixed cost. It has been mentioned over there, that is 100. Total variable cost, it has again been mentioned, it is 0, 50, 90, 120 with different levels of output. Now, if these two things are mentioned to you, that is average fixed cost, total fixed cost, and total variable cost, can we calculate total cost by looking into the formula? Total cost formula is total cost is equals to total fixed cost plus total variable cost. By adding these two, total fixed cost and variable cost, we will calculate the total cost, that is 100, 150, 190, 100 plus 120, 220, 100 plus 140, it is 240. So this is the way we will be calculating the total cost. Now how we will be calculating the marginal cost? Marginal cost is the change in total cost divided by the change in the output. So how we will calculate it? Where is the total cost? Here is the total cost. Achha, now here is the total cost. First remains the blank. Then second, change in total cost, that is 150 minus 100, that is 50, divided by change in output. So here in this case 1 minus 0, 1. So in that case 50 divided by 1 is 1. Then 190 minus 150 is equals to 40, divided by 2 minus 1, that is 1. So 40 divided by 1 we get 40. Then like this we will be calculating the complete marginal cost. Then move to the average fixed cost. How we calculate the average fixed cost? Average fixed cost formula is total fixed cost divided by output. The total fixed cost, here is the total fixed cost divided by output. So here remains the blank. Then 100 divided by 1, 100. Then 100 divided by 2, it's 50. 100 divided by 3, it's like this. Average variable cost, how we are going to calculate it? That is total variable cost divided by output. Total variable cost 50 divided by 150, then 90 divided by 245, like this. Average total cost divided, that is calculated by total cost divided by output. So this is the way if we have been given one or two items or the one or two types of cost, then we can easily calculate the other cost. So for that, first of all, you should memorize the entire formulas of cost concepts. Now this is the way how the fixed and variable cost curve is going to be made. Now on the x-axis we will be having an output, and on the y-axis we will be having the costs. So usually if we have to see all the three costs, that is total cost, variable cost and fixed cost combination, we'll be making it in a single curve. Now fixed cost will remains the same with the changes in the output, so it remains the same. It is a straight line. Now when we talk about total cost is something because it carries variable cost also. So variable cost, you can see that it is increasing as the number of units of output is also increasing. So it is in a slant way, it is also increasing. Now when we talk about total cost, which is a combination of variable plus fixed cost, it is also changing with the changes in the number of output. So this is the way how the fixed and variable cost and total cost curve is going to look like.